there's a lot of misinformation out there about annuities and really what they are. You know, sometimes what I hear is so far out there and so far off, I can't even believe what I'm hearing. I mean, what I want to do is I want to share enough information today with the viewers so that they can determine whether or not an annuity is really appropriate or is it not appropriate for them. First off, Matt, what is an annuity?
Well, I mean, an annuity can mean several different things, and it has several different purposes. So first, let me talk about some of the misinformation.
Okay.
And we can talk about, you know, how they really work. I think some of the problems that people run into, and maybe some of our viewers watching right now, get confused by the fact that there's multiple types of annuities out there.
Yeah.
And some annuities are a perfect fit in the right situation, and then other annuities would be a disaster in that same situation.
Right.
So no two annuities are always created equal. You know, they're very, very different. But as far as reasons why someone might want or use an annuity or would benefit from an annuity is maybe if they're looking for preservation of principal.
Okay.
They're worried about losing a lot of money in the stock market. There's certain annuities that can help with that. Others, not all of them do, but some of them do help with that. I think the biggest issue is it could provide a guaranteed income for life, which is, if you think about it, the only investment vehicle that's out there that can do that.
Yeah.
You know, guaranteed for life.
Right.
Some, it might be there for life, but it's the only area where it'll be guaranteed for life. So there are a lot of myths and misconceptions. I know a lot of times when we will meet with individuals, they might say something like, well, you know, I heard all annuities are bad, or I don't want an annuity because they're awful, and we'll ask them, okay, that's fair. You know, what specifically do you not like about annuities?
Right.
And then they'll say, well, I don't know. I just, you know, everybody says that they're awful
Yeah.
and we shouldn't get one. And that's frustrating.
Yeah.
Because there's some good ones, there's some bad ones, and sometimes an annuity is perfect. It's exactly what somebody should have. And then other times it's not necessarily exactly what somebody should have.
Right, right. Now, Jordan, Matt was just talking about taking an income for life. Let's say that you did take an income, though, and then, God forbid, something were to happen 3 years into it. Does that mean the money's gone now? The family doesn't get anything anymore? Or what happens then if somebody passes away?
Yeah, Dustin, that's a great question. I think you hit the nail right on the head. That's one of the biggest misconceptions that's out there with annuities. A lot of people think, like you said, if you start to take that stream of income, let's say, God forbid, 2 or 3 years, something happens and you were to pass away, all that money goes to the company. And that is certainly not the case.
No.
What happens,
It's certainly not the case in most cases.
In most cases,
right?
yeah.
Now, there are still some, in my opinion, not so good annuities that were around maybe in the 70s, maybe the 80s. They weren't real popular, but they were out there, where that could have happened to some individuals. It's nothing that we would ever recommend.
Right.
And this is where we get back into this issue that, you know, sometimes individuals might hear or think or read something that's bad about any type of investment option. It doesn't have to be the
Stocks,
annuity.
bonds,
it could
mutual
be
funds, or
mutual,
annuities.
And what they'll do is they'll read something bad about a certain investment, and then they apply it to all of them.
Right.
Yeah.
And they think they all must work that way. And you know, if you use an analogy and you say the first car you ever owned was a Yugo, right?
Yeah.
I don't even think they sell them here in the country anymore, but say the first car you ever had was a Yugo. Well, that was the biggest piece of junk that's out there, right? But that doesn't mean that a Chevy or a Ford or a Mercedes or something like that is also an awful car. So I think the same thing that happens, and we can use a lot of analogies like that, happens when it comes to annuities. There's some bad ones, but there's also the flip side, there's some good ones.
So they're both cars, but they're definitely not built,
Definitely
built
not the same.
So, now, do you have to take an income off of it? So once you open an annuity, is that the only thing it's for, is to take income off of?
Not necessarily. I mean, I think, again, with any investment that you have, in particular an annuity, what you really want is some flexibility. So you want an annuity that where if you need or want income or it's desirable to have guaranteed income for life, you can do that. But actually a lot of individuals, they don't need it.
Right.
You know, they might have pensions or Social Security covers everything. That's rare, but it happens. So you don't have to take an income. You can just let the money continue to grow and defer. And then if you never use it and you pass away, then it goes to your spouse or you know, surviving children, grandchildren, charity, whoever you want it to go to.
Is there any benefit in that when you do pass away with an annuity? Is it easier or harder to pass on to heirs?
Well, again, depends on the situation. Every annuity is going to have a named beneficiary.
Okay.
So that's true with pretty much any IRA.
Yeah.
But if you deal with some non-qualified investments, like say you have money in a stock brokerage account or CDs at the bank, things like that, they're not necessarily going to have a named beneficiary, whereas an annuity will have one. So sometimes individuals will use them for estate planning purposes because it's an asset that will bypass probate.
Okay, okay. Jordan, how do fees work on annuities? Do all of them have fees? Are they high? Are they low?
No, not all annuities have fees. Just like Matt kind of said, every single strategy is different with an annuity. Some are good, some are bad. Some are going to have really high fees. I know with some of the accounts that we see oftentimes, like a variable annuity, those fees could be somewhere between maybe 3 to 7%. I was reading something the other day. The nation's average is right around 5%.
Wow. Yeah, it's crazy.
Yeah, it's crazy. So if you think about it, you have $100,000, the average fee's 5,000 or 5%. You're going to be paying $5,000 a year over a 10-year period. That's a $50,000 loss. So
whether it makes money or loses money.
whether
right?
it makes money or loses money, absolutely.
Now, this is a variable annuity,
This
right?
is a variable annuity,
Okay.
which again, not all annuities are created equal.
Yeah. So if you go with something like a fixed annuity or an index annuity, more often than not, they're not going to have any fees whatsoever.
Okay.
What's happening there is the company is making money on the money while it's on deposit with them.
Okay.
So they're not charging any fees unless you want to add some optional benefits. And in those scenarios, usually the fee's pretty reasonable, almost always below 1%, but that's an option. You don't have to even pay that.
Well, with the variable annuity, Jordan was saying fees in the 5% range. Is that why annuities sometimes get a hard time?
I think so,
Yeah.
and it's not optional.
Right,
With
yeah.
the variable annuity, they're going to charge it whether you think it's fair or not. They're
Yeah.
going to charge that. And so that's going back to what I said earlier. You might go out and research annuities, and if you see an article that's written that talks about, hey, this annuity out there charges 3 or 4 or 5% per year, sometimes people will get the misconception, well, that's how they all work.
Yeah.
And that's certainly not the case. There's good ones, there's bad ones, there's really high fee ones, and then there's some no fee ones that can be very beneficial.
Okay. Jordan, now, one last question on annuities. Are all agents and advisors going to sell the exact same product?
Absolutely not. No, absolutely not. The big thing to look for in an advisor is, are they captive or are they independent? I think that's a really, really important distinction, which a lot of times what we'll find, maybe someone who's recommending a variable annuity, they're captive to maybe 2 or 3 or 4 different companies, or maybe even less, sometimes just one company,
Yeah.
but they have to recommend that product.
Yeah, well, let's explain that a little further because our audience might not be completely familiar with captive versus non-captive. What Jordan's talking about is if we have a captive advisor works for a certain company, well, that company is going to dictate what products he or she can recommend to their clients.
So these 3 products fit all of your clients?
Yeah, that's
Right,
it.
Okay.
Yeah, no matter what. Whereas if you work with an independent advisor like ourselves, we would have those few options available, but then we would have everything else in between as well. So the advice that you get from working with somebody that's a captive versus non-captive usually is night and day. You always want to work with somebody that's independent, in my opinion.
Okay. So if you have any questions about how annuities work and whether or not they're appropriate for you, we've got a report at the office. If you give us a call, we can send one to you. And how much do you really need to take? How much can you take in your portfolio and still be okay into and throughout retirement? Matt, I know we talk a ton on this show about
Quite a
risk.
bit, yeah.
How much risk should someone be taking? I mean, does it vary or is it kind of a standard answer? On this segment, I want to talk about risk and how much do you really need to take? How much can you take in your portfolio and still be okay into and throughout retirement? Matt, I know we talk a ton on this show about
Quite a bit,
risk.
yeah.
How much risk should someone be taking? I mean, does it vary or is it kind of a standard answer?
Wow, I mean, it's completely different for everybody, right?
Yeah.
Some people don't want to have any risk whatsoever.
Right.
If they lose a couple dollars in their portfolio, they're pretty upset.
Yeah.
Others understand that sometimes the market goes up and goes down. So it's something that's really different depending on the individual, depending on their goals and objectives.
Yeah.
If someone's younger and they've got a lot of time before they're going to retire, they can maybe afford a little more risk than someone that's a few years from retirement.
Yeah.
So it makes sense, obviously, to analyze it first.
Okay, okay. So what I've put up here is this CAN is, of course, an acronym with us.
Right.
So the first one here is really, when you meet with someone, you need to understand, first off, the capacity, what their capacity for risk is. So I'm just going to write capacity up here. And what that means, and I'm going to pick a lot on the brokerage firms, first off.
Okay.
When you go in there and you talk to someone at a brokerage firm, what are they going to do to find out what your risk level is?
Well, they're probably going to score you,
Yeah.
maybe, take a little quiz and 5 or 10 questions, and then you get a score, and then that tells them exactly what they should
They
do.
know everything about you risk-wise, right? And then they
Right.
print off a beautiful report that tells you that you're a moderate investor. So
Right.
how much risk can a moderate, as far as the brokerage firms, how much risk do you think that would be?
Well, they're the experts, right?
Yeah.
So shouldn't they know?
Yeah, well, they're
Right.
the experts. So
Yeah, so I would think somebody moderate probably we would be okay, maybe losing 5 or 10%, maybe.
Well, that's what I would think. But with a brokerage firm, moderate means 30% loss on their risk-alive score. That's
Okay.
that's kind of a standard answer anyways.
That doesn't feel very moderate.
To us, it doesn't. You're
Right.
right. Now, the next question I want to ask, and we want to understand, is we go a little bit deeper than the brokerage firm. They stop here, they make recommendations.
Obviously, yeah.
With us, we go a little bit further. We want to understand what's their attitude. How much risk really can they stomach? Because if they feel they're moderate, they don't feel like 30 is okay. They might think 5 or 15%.
Right.
So let's say that the attitude of someone that comes into the office is they'd be okay if they had a year where their portfolio fluctuates maybe 15%.
So how do we figure out the attitude? We can just tell when they come in?
Oh, well, I'd say we need to ask quite a few questions. I mean,
Right.
yeah, what have they been through? And, you know, did 2008, how did that affect them?
Right.
Do they want to go through that ever again? And I think just asking a lot of questions and understanding what their comfort level is, we could determine what that number is.
Okay.
We've got an assessment exercise, actually, you and I go a little deeper, but
Right.
a lot of questions are going to get us there. Now, once we understand what their comfort level is, do they really need to take that much? So
Right.
the end here is yeah, you may be comfortable knowing that 15% is kind of a number that you could stomach, but why go out and take a bunch of risk if you don't need to?
Now, I see this all the time from individuals
Yeah.
where they maybe look at it and they say, well, you know, I understand the market goes up and down over time. Hopefully, in the long run, it'll always be okay. But you look at their portfolio and they might have enough money to maintain their standard of living, reach all of their goals, and they're taking a lot more risk than what they really need to be taking.
Right.
It's something that's pretty frustrating because we see it all the time.
All the time. And I always say the whole reason to take a bunch of risk is so you can get yourself in a position to retire.
Right.
If you're there needs to be a real paradigm shift. It's no longer how much can I grow my portfolio to. Now it's I need to make this last me the next.
Well, and that's the main thing because, you know, risk reward, right?
Yeah.
You typically would take more risk because you assume, not always the case, but you assume you'll get a bigger reward. Well, some individuals, it's nice to get a bigger reward, but they don't really need it.
Right.
And I
right.
really think that as you move closer into retirement, what ends up happening is a loss potentially. If you're taking risk, you can suffer a loss. A loss is going to hurt you a lot
So much
more,
more, yeah.
than a gain is actually going to help you. So
That's right.
a lot of times we see that's really, really important that individuals are taking more risk than they need to.
So sometimes we find that really you don't really need to take much more risk than maybe 5% or something like that to hit all your goals. But when you're at a brokerage firm and as a moderate investor, they may have you way up here. So we always feel like it's a good idea that if you are kind of a moderate to conservative investor, get a stress test done. I mean, get something ran on your portfolio to understand how much risk do you really have, and does it match up with what your capacity, attitude, and real needs are. So if you have any questions about your portfolio and how much risk you currently have, call our office, get a stress test ran on your portfolio so that you can get a good understanding as to what you currently have.
What we're talking about are accounts where you're maybe paying some sort of financial institution or typically a financial advisor some sort of a wrap fee or management fee, or sometimes referred to as advisory fee, to manage your money. When it comes to your retirement accounts, we always recommend that you avoid having any money whatsoever invested in what we refer to as double dip accounts. So what is a double dip account, right? What we're talking about are accounts where you're maybe paying some sort of financial institution or typically a financial advisor some sort of a wrap fee or management fee, or sometimes referred to as advisory fee, to manage your money. These fees are typically somewhere between maybe 1% to as high as maybe 2%. Usually the larger your portfolio is, typically the lower these fees are going to become. And a lot of times individuals, when they have money invested in some sort of a portfolio like this, they think that that's all that they're paying. And sometimes that's true, and then other times it's not the case. Other times individuals have what's referred to as a double dip account. And where the double dip comes into is you may be paying the advisory firm or the brokerage firm some sort of an advisory fee, but then if they're turning around and investing the money in other types of assets that have fees in addition to what you're paying them, that's where the double dip comes into play. The most common double dip account is going to have some sort of mutual fund portfolio invested in it. Sometimes it could be an ETF or exchange traded fund portfolio, but this certainly is the case when you have mutual funds. So although you may be paying your advisor 1 or 1.5 or 2% per year, if they're using mutual funds as the underlying investment within the portfolio, then you also have to pay those mutual fund companies their fees. And when you look at a mutual fund, obviously you're going to have a management fee, which is going to be the fee that they're charging for doing the management of that portion of the portfolio. And then you also have what's referred to as trading costs. And what trading costs are, as a mutual fund, whether it's a stock fund or a bond fund, as they are buying and selling different stocks or bonds, that comes at a cost. So when you look at a portfolio, you want to know what the advisory fee is that you're paying the advisor. If you have mutual funds, you want to know what the management fee, but then you also want to know what the trading costs are. And the way that you can determine that is by figuring out how much turnover you have within the mutual fund. So even though the advisor might not be trading the funds around very often, the mutual fund is still going to have trading costs because they're going to be buying and selling different stocks and or bonds within that portfolio. And the higher the turnover or the higher the trading cost, obviously the higher the fees and expenses are going to be for you. So it's not uncommon for us to see individuals maybe paying a management fee to their advisor of 1 to 2%. If they're using mutual funds, though, when we add those costs in, that's usually another 1 to 2 to maybe as much as additional 3% in fees. So sometimes individuals might think, well, I pay my advisor 1.5% per year, seems fair, I'm kind of okay with the returns. But the true story might be, once you add in the cost of the mutual funds, you may be paying a total of 3 or 4 or 5% per year. Let's just say it's just 3%, and let's say, as an example, you have $100,000 in a double dip account or double dip portfolio. Well, if you're paying 3% in fees, that means that you're losing about $3,000 per year. Over a 10-year period, that means that you would lose about $30,000 in fees on just a $100,000 portfolio. So obviously, if you have hundreds of thousands of dollars, or in some cases millions of dollars invested in these types of portfolios or these types of accounts, the costs are going to add up and become pretty significant over time. And it literally, over a 5 or 10 or a 15-year period, can mean the difference between having a successful retirement or struggling at some point in the future. So if you're not sure if you have a double dip account or not, or if you'd like us to review anything within your portfolio and find out exactly what the total cost is, not just what you're paying your advisor, but what the total cost is once you add all of the fees and expenses together, feel free to give us a call at the office and or you can visit us on our website.
We want to look and see if there's a possibility where we can get more upside gain potential than downside loss potential. Or in some instances, what we'll find with individuals' portfolios is they have more loss potential than upside gain potential. Welcome to this week's segment of Strategic Wealth University. Today, we are up here on the board. We have some really exciting information that we want to share with you. And today, what I want to talk about is what's known as asymmetrical risk, right? We want to talk about asymmetrical risk. So the question is, oftentimes whenever we look at individuals' portfolios, they'll want to take a certain amount of risk to get a certain reward. Or they'll want to have a certain amount of money safe and protected to get a certain amount of upside gain. So what we want to do is we want to kind of flip that notion on its head. We want to look and see if there's a possibility where we can get more upside gain potential than downside loss potential. Or in some instances, what we'll find with individuals' portfolios is they have more loss potential than upside gain potential. Now, the notion of asymmetrical risk is really simple. If we look here up on the board, what I want to draw for you is risk versus rewards. And what we're going to do is we're going to look at the most safe investment class, which could be cash or treasuries, and one of the most risky investment classes, which could be small cap stocks or emerging markets. So what I want to do up here is I want to draw for you risk versus rewards. So if we look here on the bottom of this graph, we have risk. And then if we come over here, we have reward. And what this risk versus reward is going to show us is as we move further and further up on the graph, the more and more risk that we take. So if we look towards here at the bottom, there's no risk, therefore, there's no reward. And if we look up here, there's a ton of risk, but the reward is also equal to it. So if we look along the line right here, what we find is that if we look here towards the bottom, and we could say, for an example, this right here, this point is cash or treasuries. The most safe investments that we can have, because there's not really any risk, and because of that, there's not really any reward. Now, if we look up here towards the top, let's say as an example, this point right here is emerging markets, or it's quite possibly maybe small cap stocks. So there's a ton of risk, and there's also a lot of reward. If we come here, maybe this point is going to be bonds, maybe this point is just going to be normal stocks. So what we'll oftentimes find is individuals' portfolios are going to stay on this line. Maybe a couple of them come inside here at these points right here. Maybe a couple of times what we find is maybe unintentionally they have more upside gain potential than downside loss potential. And what we're striving to do and what we want to try to accomplish in different portfolios is somewhere along this point right here. We want to be somewhere along this line where we have more reward than we have risk. So the question is, how did someone accomplish that? How do you get more reward in your portfolio than risk? Well, first and foremost, the best way to accomplish that is to have what's known as asset class allocation, right? Asset class allocation. It's a real simple term. It might sound a little technical, but it's for a real simple thing. And that just means, where's your money? So traditionally what we find with portfolios is maybe they just have stocks or real risky investments, or maybe they just have bonds. But not all investment classes and not all asset classes move in the same directions. So what we want to do with our portfolios is we want to have proper asset class allocation. We want to have different investments on different points of this line. And what we want to do is we want to spread our risk out evenly through the only 4 economic seasons really that there are. We have good growth, we have bad growth, we have high inflation and low inflation. And what we do is we want to spread out our risk evenly throughout those 4 different groups of investments. So if we look up here, we want to accomplish the situation where we're in this area. And the best way to do that is to have more reward than risk in your portfolio. And the way to accomplish that is through asset class allocation. Whereas we have money invested in maybe possibly stocks and bonds, but we also have money invested in different commodities, in treasuries, in precious metals, in real estate, in all of these different asset classes and asset groups that are going to move in different directions. So in good markets, in bad markets, in high inflation markets, and in low inflation markets, we can first and foremost stay safe and protected and also get good growth potential. Now, if you'd like more information about asymmetrical risk, give us a call. Check us out on the website. Thank you all for tuning into the show this week, and we look forward to seeing everybody back here next week for another week's segments. Thank you.